The critical factor in the calculation of deferred tax on revalued assets is the tax base. You should refer to the flowchart on how to calculate tax base correctly depending on the different circumstances and assumptions. The general rule is that the amount of tax payable is dependent on the intended use or manner of recovery of the asset. An asset may be recovered through use or sale, and there is also an exception to this general rule. Here, we focus on the recovery of an asset through use. The tax base of an asset does not change when the asset is revalued if the intention is to recover it through use. Consider a tugboat with a carrying amount of $50,000 and a tax base of $40,000 on 30th December. We can use this grid to calculate deferred tax. By substituting the amounts that we know and calculating the other amounts as balancing figures. The temporary difference is $50,000 minus $40,000 and the deferred tax is 30% of the $10,000 temporary difference. The tugboat is revalued to $70,000 on 31st December. If the owner intends to hold the asset for use, what will be the deferred tax, asset or liability, and what will be the journal entries for the revaluation? The tugboat has a carrying amount of $50,000. The revaluation of the tugboat resulted in an increase of $20,000. This indicates that the tugboat will bring in an additional taxable income of $20,000 for the owner, since he intends to recover this asset through use. Thus, the entire revalued amount is taxable. The deferred tax on the revaluation is $6,000. Let's update the grid with the increase of $20,000 to the carrying amount, leaving the closing balance of $70,000. Remember that the tax base does not change when an asset that is intended to be recovered through use is revalued. So we can calculate the other missing amounts. The tax base remains unchanged at $40,000 and the additional temporary difference of $20,000 leads to a closing balance of $30,000. There is also a $6,000 increase in the deferred tax, which is at 30% of $20,000 temporary difference. Using the shortcut approach, we know that there is a debit balance after the tax base was deducted from the carrying amount. Thus, this is a deferred tax liability. The final deferred tax liability amount is $9,000. The deferred tax expense relating to the revaluation is the movement in the liability. In this case, the deferred tax expense is $6,000. You should note that we already calculated the $6,000 earlier. This grid confirms our earlier calculation. In terms of IAS 16, gains on revaluation should be taken to other comprehensive income. So the deferred tax expense journal relating to the revaluation will also be taken to OCI. The entry will be a debit to revaluation surplus of $6,000 and a credit to deferred tax liability of $6,000. To recap, if an asset is to be recovered through use, the tax base does not change when it is revalued and the entire revalued amount will be taxable.